Let me ask you something. And I want you to be honest with yourself when you answer it. When you hear the phrase, trading small, what's the first thing that comes up in your head? Is it this? Trading small is for people who are scared. People who don't believe in themselves. People who are too timid to actually make real money. Maybe you don't say it out loud, but somewhere in the back of your head you believe it. That going big is how you get ahead. That the only way to make serious money is to risk serious money. That if you're only putting in 1% per trade, you're basically playing pretend. I know that feeling because I used to live inside it. I used to sit at my screen and look at my position size and feel embarrassed by it. Like I was leaving money on the table. Like the traders who were really making it were somewhere else, risking more, winning more, living more. So I went bigger. And bigger. And I'll tell you exactly what happened and why the day I finally forced myself to go small was the day I stopped bleeding. Here's the thing nobody wants to say clearly in the trading world. We are all conditioned from birth to believe that more effort equals more reward. You work more hours, you earn more. You study harder, you score higher. You invest more money, you get more back. That logic is wired so deep into us that we bring it into the market without even realizing it. And the market, quietly, without mercy, uses that belief against you. Because trading is not like anything else you've ever done. It doesn't reward effort the way a job does. It doesn't reward commitment the way a relationship does. It doesn't even reward intelligence the way a test does. Trading rewards one thing and one thing only: correct decision-making under pressure. And here's what most traders never figure out. Your ability to make correct decisions under pressure is directly tied to how much you have at risk. The bigger your position, the more distorted your thinking becomes. The more money on the line, the less you're actually trading, and the more you're just reacting. You think you're being bold. You think you're being decisive. But what's actually happening is your nervous system has taken over and logic has left the building. Think about the last time you had a really large position open. Do you remember what that felt like? The way your eyes kept flicking back to the chart. The way every candle that moved against you made your chest tighten. The way you started bargaining with the market. Just come back a little, just give me a small bounce, I'll take it and close. That is not trading. That is survival mode. And survival mode has a terrible win rate. Let's talk about the real cost of trading big. And I don't mean the money you lose on bad trades. I mean the invisible cost. The one that accumulates so slowly you don't even notice it's happening. When you risk too much on a trade, you do something to your brain that takes days to undo. You spike your cortisol. You put yourself in a state of heightened stress. And that state, even after the trade is closed, win or lose, lingers. You close a trade at a loss and you tell yourself you're fine. You open another one. But your brain isn't fine. Your brain is still in damage control mode. It's looking for a way out. It's looking for relief. Not profit, relief. And so every decision you make after a big losing trade is quietly shaped by that need for relief. You close winners too early because you need to feel something good. You hold losers too long because you can't face another loss right now. You increase size on the next trade because some part of you believes one big win will undo the pain. Sound familiar? This is the spiral that kills account. Not one big loss. A chain of psychologically compromised decisions made by a brain that is simply trying to get back to a neutral emotional state. Trading big doesn't just risk your money on that one trade. It mortgages your decision-making for every trade that follows. Now flip it. Think about what happens when you trade small. When the risk on a single trade is genuinely manageable. When a loss stings a little but doesn't break you. Your brain stays calm. You can actually look at the chart and see what's there instead of what you need to be there. You can cut a losing trade without it feeling like an identity crisis. You can move to the next setup without carrying the emotional weight of the previous one. That is not weakness. That is the mental environment in which good trading actually happens. Now let me show you something that changed the way I saw this completely. And it's not complicated. It's just math. Math that most traders never sit down and actually look at. Take two traders. Same starting capital. Same strategy. Same market. Same win rate. Trader A risks 10% per trade. Trader B risks 1% per trade. Both of them hit a losing streak. 5 losses in a row. Completely normal. Expected, even. Every strategy has losing streak. Every trader, no matter how skilled, will string 5 losses together at some point. Trader A is down nearly 41% of their account. They need to make back roughly 69% just to get back to where they started. Not to get rich, just to break even. Trader B is down 5%. They need to make back 5.3% to recover. 1 decent week. Maybe 2. But here's where it gets really dark for Trader A. Because it's not just the money. At 41% down, something happens to a trader psychologically that is very hard to come back from. You stop trading to make money. You start trading to not be down. And those are 2 completely different games, and only one of them is winnable. Trader A is now desperate. They need big moves. They can't afford to sit out unclear markets. Every session feels like it matters too much. The pressure distorts everything. Trader B sits down the next day as a functioning trader. Slightly annoyed. Recalibrating. But intact. Who do you think makes better decisions over the next month? And here's the part that actually surprised me when I first worked through this. Over a long series of trades, hundreds of trades, the small risk trader doesn't just survive better. They often come out ahead in absolute terms. Not because their percentage gains are bigger, but because they were never knocked so far back that recovery took months. They were always close enough to the surface to keep swimming forward. Compounding only works when you don't break the chain. And aggressive trading breaks the chain constantly. I'm going to tell you about a period in my own trading that I don't talk about much. Not because I'm ashamed of it, I've made peace with it, but because it's uncomfortable to admit how convinced I was that I was doing the right thing. I had been trading for about a year and a half. I had a strategy that I genuinely believed in. I had studied it, tested it, watched it work. And I was impatient. I had been grinding small positions for months, and the account was growing, but it felt slow. It felt like I was running a race in slow motion while everyone else was sprinting. So I made a decision. I told myself I had earned the right to size up. I had put in the time. I understood the strategy. The risk of staying small, I convinced myself, was that I'd miss the window of opportunity. That the market would move without me being positioned to really benefit from it. That logic sounds reasonable. It's not. But it sounds reasonable. And that's the danger. I went from risking 1% per trade to risking 5%, sometimes 7%. And for a few weeks it felt incredible. The account moved faster. I felt like I had finally stepped into the version of trading I had been aiming for. Then the losing streak came, as it always does, and I watched what happened to my thinking in real time. I watched myself hold trades I should have cut. I watched myself enter trades that didn't meet my criteria because I needed to get it back. I watched myself increase size on a trade that felt sure, the most dangerous sentence in trading, and lose more in one session than I had made in the previous 3 weeks. The strategy hadn't changed. The market hadn't conspired against me. My position size had simply gotten large enough to compromise every single decision I was making. I went back to small. Not because someone told me to. Because I was desperate enough by that point to try anything. And within 2 weeks I could feel the difference. Not in the account first, in my head. I could think again. I could see the chart for what it was rather than what I needed it to be. That was the lesson I had to pay a painful price to learn. And I'm giving it to you for free right now. I want to address something directly because I know what some of you are thinking right now. Okay, but if I only risk 1% per trade, I'll never make enough to actually change my life. The numbers don't work. I understand that feeling. And I'm not going to dismiss it by telling you to be patient and trust the process. Let me actually address it. You are not going to stay at 1% forever. The goal of trading small early on is not to stay small forever. It is to stay in the game long enough to build the skill, the consistency, and the track record that justifies scaling up. You cannot skip that phase. Every trader who tried to skip it paid for it. The account size is not the bottleneck you think it is. The bottleneck is your ability to execute consistently. A trader who can demonstrate a consistent edge on a small account can attract capital, get funded, or scale their own account from a position of strength rather than desperation. But none of that is available to you if you've blown up twice trying to speedrun the process. And this is the one I really want you to sit with. Trading small forces you to build something that trading big destroys. It builds your relationship with process over outcome. When the risk is genuinely low enough that a loss doesn't devastate you, you can actually focus on whether you're executing correctly, whether your entry was valid, whether your risk was placed logically, whether you managed the trade according to your plan. Those questions are impossible to answer honestly when you're in fight or flight mode staring at a position that represents 10% of your account. Trading small gives you the mental space to actually get better. And getting better, real, measurable, sustained improvement, is the only thing that leads to lasting profitability. Not a bigger position size. Not a more aggressive approach. Better. Let me make this concrete because I think a lot of people here trade small and picture some kind of joyless, timid existence where nothing meaningful ever happens. Here's what it actually looks like. You sit down for your session. You've defined your risk per trade. You look at the market. You wait for your setup. Not almost your setup. Your setup. The exact conditions you've defined in advance. A setup appears. You check it. It qualifies. You calculate your position size based on where your stop-loss logically sit. You enter the trade. Here's where small trading changes everything. You are not staring at that trade every 30 seconds. You are not refreshing the chart looking for confirmation that you were right. You place the trade, you set your stop, and you either walk away or you watch it with genuine detachment, because the amount at risk is small enough that you can actually afford to let the trade play out. If it loses, you take the loss. It stings. But it doesn't break you. You're still 99% intact. You move on. If it wins, you let it run. You don't close it early because you're terrified of giving back profit. You don't move your target because you're feeling greedy. You follow the plan. Because nothing about this trade has compromised your ability to think straight. That's it. That's the whole game. Repeated consistently over hundreds of trades, that process builds something that no amount of aggressive trading can buy. It builds a track record of rational execution. And that is the foundation everything else is built on. Trading small is not a sacrifice you make while you wait for the real game to start. Trading small is the real game, at least until your consistency earns you the right to scale. The traders who last. The ones who are still here after 5 years, 10 years building something real, they are not the ones who took the biggest risk. They are the ones who protected their ability to keep playing. You cannot compound what you have already lost. You cannot build on a foundation you have already broken. And you cannot make good decisions from inside the psychological state that big losses create. Trading small is not about being timid. It is about being intelligent enough to see the game for what it actually is. A game of survival first. Profitability second. The market will still be there tomorrow. And the day after. And next month. The only question is whether you will be. Protect that. Everything else follows.